Right now, while you're watching this, three things are happening that you have almost no control over. Your bank is lending out money you don't know about. A government is printing currency that's quietly losing value in your pocket. And somewhere in a server farm, dozens of banks are playing a game where the stakes are your job, your rent, and whether your savings actually mean anything. Most people think banks just hold money. That's wrong. What banks actually do is far stranger, far more powerful, and far more fragile than anyone wants to admit. And the rules of this invisible game have been rewritten so many times we've forgotten they were ever rules at all. This is the story of what happens in the dark spaces between your paycheck and your future, and why understanding it might be the most practical thing you ever learn. Let's start with something you've definitely noticed. Everything costs more than it used to. Not because things got better, because the money itself changed. In 1990, a gallon of gas cost $1, a dozen eggs 70 cents, a new car $15,000. Today, those same things cost $4, $5, and $35,000. That's not inflation. That's not natural. That's a choice someone made. The money supply in America has increased by roughly 80% in just the last 15 years. 80%. And most of that didn't come from the government printing bills. It came from banks creating it out of nothing. Here's the part that makes people uncomfortable when they realize it. When you take out a loan from a bank, the bank doesn't give you money it already had. It creates new money. It writes it into existence, and then you have to pay it back with interest. This is why the economy needs to grow constantly. It's not a choice, it's math. More money in circulation means the same amount of stuff is chasing more dollars, so prices go up. Your purchasing power goes down, and you feel poorer while everyone tells you the economy is fine. But understanding why this happens requires going back further. We need to understand how banks actually work, because most people's mental model of banking is 20 years out of date. Picture yourself in 1990. You go to your bank with $10,000 in savings. The banker is wearing a suit. He puts your money in a vault. You get a passbook. That's banking as most people still imagine it. Except that's not what happens. That hasn't been what happened for a very long time. Here's the actual system. You deposit $10,000. The bank legally owns it now. You own a claim on it. There's a critical difference. The bank then takes that money and does something with it. They might lend it to someone buying a house. They might buy government bonds. They might trade it. They might use it in ways you'll never know about. The only requirement is that they keep enough cash on hand to handle normal withdrawals. In the United States, that requirement used to be around 20%. Today, it's closer to zero for most banks. They're not required to hold reserves at all. So imagine this scenario. 100 people deposit $10,000 each. That's $1 million. The bank keeps $50,000 in actual cash. They lend out the other $950,000. Now imagine half of those deposits are withdrawn at the same time. The bank has $45,000 in cash but needs $500,000 to pay depositors. They're insolvent, not because they made bad bets, just because of the math of the system. This is called a bank run, and it can happen instantly, which is why banks need each other. This is where it gets interesting. Banks don't trust each other, so they created a secret game. It's called the interbank lending market. Every single night, banks figure out who has too much cash and who needs cash. Then they lend it to each other. The price of that lending is called the federal funds rate. It's the most important interest rate in the world, and almost nobody knows it exists. Here's why this matters. When the federal funds rate is low, banks can borrow money cheaply, so they lend it out aggressively. Mortgages become easier to get, credit card limits increase, credit spreads, the money supply expands. When the rate is high, banks tighten, lending freezes, money contracts, businesses can't afford to expand, they lay people off, unemployment rises. A single number, set by a group of unelected officials at the Federal Reserve, controls whether you can get a loan, whether you keep your job, whether the economy booms or crashes. And here's the uncomfortable part. They don't really know what they're doing. The Federal Reserve has no perfect way to measure the real economy. They have models, data, but the economy is a system so complex that small changes in one corner can collapse everything. They're essentially flying an airplane through clouds using instruments they built themselves, hoping the instruments are accurate. In 2008, the instruments failed. The interbank lending market stopped working. September 15, 2008. Lehman Brothers collapsed. It had been a bank for 164 years, gone in a day. What happened in the weeks before was terrifying if you understood it. Banks stopped trusting each other. The interbank lending market froze. Banks couldn't borrow from each other, which meant they couldn't lend to anyone, which meant the entire economy was about to lock up. The government faced a choice: let the entire banking system collapse and take the economy with it, or bail them out. They bailed them out. The Federal Reserve created $7 trillion. That's trillion with a T. They handed it to banks in the form of loans. They bought bad mortgages. They did things that were technically illegal under existing law, but they did them anyway because the alternative was worse. And here's the part that reveals how the game actually works. The banks that took the money kept paying their executives bonuses. The traders who made the bets that caused the crisis weren't fired, they got promotions. The people who lost their homes didn't get bailed out, they got foreclosures. Risk was socialized, profit was privatized. This isn't a bug in the system, it's the design. Let's think about what happened next. After the crisis, the Federal Reserve kept interest rates near zero for 13 straight years. This wasn't an accident, it was intentional. They were trying to force banks to lend money and get the economy growing again. And it worked, sort of. What it actually did was create a situation where borrowed money was free. If you could get a loan, there was no cost to using that money. So people borrowed, businesses borrowed, governments borrowed, investors borrowed. They borrowed to buy houses, to buy stocks, to start companies, to buy other companies. By 2020, total debt in the American economy was $260 trillion. That's about 10 times the size of the entire economy. It was unsustainable. Everyone knew it. No one did anything about it. And then something unexpected happened. The pandemic hit. Suddenly, people couldn't work. Demand for goods collapsed. Then it exploded. Supply chains broke. Inflation spiked. For the first time in 40 years, it was a real problem. The Federal Reserve faced a choice: keep rates low and watch the currency collapse, or raise rates and crash the economy. They raised rates fast. Between March 2022 and July 2023, they raised the federal funds rate from near zero to over 5%. It's the fastest rate increase in decades, and it did exactly what it was supposed to do. It broke things. Small banks started failing. Credit markets seized. People who had borrowed aggressively suddenly couldn't refinance. Companies that were profitable at 0% interest became insolvent at 5% interest. The music stopped, and there weren't enough chairs. Here's where the story gets strange. The government's solution to the crisis of 2008 was to give more power to banks. The Dodd-Frank Act in 2010 was supposed to prevent another crisis. Instead, it made big banks bigger. The 6 largest banks in America now control nearly 70% of the banking assets. They're too big to fail, which means they can take enormous risks knowing the government will bail them out if they lose. The incentive structure is inverted. Banks profit when things work, banks profit when things break. This is why the game between banks matters to you personally. When banks are playing aggressively in this invisible game, they're using leverage. That's borrowed money. They might borrow $100 for every dollar they actually own. That magnifies returns when things go well. It magnifies losses when they go poorly. And when they lose, you pay. The 2008 bailout cost taxpayers roughly $20 billion in net losses.
That's money that could have gone to schools, infrastructure, or been returned to people as tax cuts. Instead, it went to banks. The money that the Federal Reserve created didn't disappear. It went somewhere. Some of it went to banks. Banks invested it. The stock market tripled between 2008 and 2020. Housing prices tripled. If you had assets, you got rich. If you were renting, you got poorer. This is why wages are stagnant even though the economy is growing. The growth is happening in asset prices, stock prices, and real estate prices. If you own those assets, you win. If you don't, you lose. Let's zoom out now and think about the bigger picture. The invisible game between banks shapes your life in ways that are almost impossible to see. It determines whether it's a good time to buy a house or a terrible time. 3 years ago, mortgages were at 3%. Today, they're at 7%. That's not a small difference. A $500,000 house costs $300 more per month on a 7% loan.
A 5% loan than a 3% loan. Over 30 years, that's over $100,000 more. The house didn't change. The money did. It determines whether you should save money or spend it. In 2022, you could get 5% on a high-yield savings account. In 2020, you got 0%. The bank's lending rates didn't change that much. The interest rate they pay you moves based on what the Federal Reserve does. When rates are low, saving is punished. When rates are high, saving is rewarded. Most people don't understand they're being incentivized or disincentivized by the invisible game. It determines job security. When the Federal Reserve raises rates, unemployment rises. This isn't theory. This is intentional. The Federal Reserve uses unemployment as a tool to control inflation. They'd rather have millions of people lose their jobs than let inflation get too high. This is called the Phillips curve, and it's accepted as fact in economics, even though it's essentially saying that poverty is a feature, not a bug. It determines whether small businesses can expand. Big companies can borrow on favorable terms. They have credit ratings and relationships with banks. Small companies can't. When rates are high, small businesses stop hiring. When small businesses stop hiring, unemployment rises. When unemployment rises, people get desperate. When people get desperate, they accept lower wages. Lower wages mean corporations have lower labor costs. Lower labor costs mean higher profits. The whole system is designed to gradually transfer wealth from workers to owners of capital. This isn't a theory. This is how the game is played. But here's where it gets more complicated. Banks also need to lend. They need the money in circulation, because if nobody borrows, the money supply contracts, and that causes deflation, which is even worse than inflation. Deflation is when prices go down. It sounds good until you realize what it means. If you know prices are going down next year, you don't buy anything today. If people don't buy, businesses go out of business. If businesses go out of business, people lose jobs. If people lose jobs, they can't pay debts. If they can't pay debts, banks collapse. If banks collapse, the entire financial system fails. So the game that banks play is actually a balancing act. They have to keep lending. They have to keep the money supply growing. But they can't let it grow so fast that inflation destroys the currency. They're trying to walk a tightrope between collapse and hyperinflation, using an economy of 300 million people as their balance pole. And they do this approximately every 10 years. Boom cycle, bust cycle. Boom, bust. Sometimes the cycles are longer, sometimes shorter, but they never stop. In 2001, there was a recession. They stimulated. The housing bubble grew. In 2008, the housing bubble burst. They stimulated massively. The stock market bubble grew. In 2020, COVID hit. They stimulated massively. Housing and stock market bubbles grew bigger. In 2022, they realized they stimulated too much. They tightened. The economy started breaking. In 2023, they panicked and loosened again. The stimulation in 2008 didn't prevent the next crisis. It delayed it and made it bigger. The stimulation in 2020 didn't prevent the next crisis. It delayed it and made it bigger. And right now, we're in the loosening phase again, which means money is being created, which means your purchasing power is declining, which means you're getting poorer even if your salary stays the same.